Annuity basics. You have to understand the basics of annuities if you want to become successful in helping people preserve and protect their retirement. One of the most fundamental aspects of annuities is a guaranteed rate. There's also income, potential higher growth. But in this video, I want to talk about the fixed rates, just pure fixed rates, nothing fancy. You park money with an insurance company. They pay one rate, 3, 4, 5, 6%, depending on the time that you're watching this. Interest rates can be different and rates can be different also. But the concept is the same. You park money with an insurance company and they give you one flat rate for the entire term of the contract. Most of the MYGAs, multi-year guarantee annuities, they're going to be between 3 and 5 years. They also make them for longer periods of time, but the most popular are 3-year and 5-year. So let me give you an example of how these work. If you move $100,000 from an IRA or a checking savings account, it doesn't really matter. You move that money over and it sits with an insurance company. In return, since the insurance companies, they're going to be making some money on that, they're going to go ahead and pay a particular interest rate. Maybe it's 5%. Let's just use that because that's kind of a hot number right now. 5% for 3 years, not bad. They get credited interest once per year, and then at the end of the 3rd year, their contract is totally freed up and they can move it wherever they choose to. Pretty nice. Maybe they want a rate that's a little bit longer period of a time. Maybe they want to have a 7-year rate. The advantage of a 7-year rate is it actually locks in that rate of return for 7 consistent years. Maybe they want to go 10. Maybe they want to go 5. It doesn't matter. What matters is how the policy actually operates and having the client understand what they are essentially purchasing. All right. Now, a MYGA, again, is a multi-year guarantee annuity. You park money into it and it pays an interest rate. A couple things we have to keep in mind. How is the interest being applied? Some of these will tell you daily compound, there's annual percentage yield. Most of the MYGAs that we deal with, they're going to have everything based on an annual percentage yield. So even though it may be calculated daily, you want to look at the actual effective yield at the end of the year, at the end of the term. Because a lot of these companies, they'll say, hey, it's 5.5%, for instance. And then they'll say in the contract, it's calculated daily. Well, yes, but when it calculates daily, it's giving you the 5.5%. If you told somebody that, say, hey, you're going to get 5.5% rate of return throughout the year, and it's calculated daily, it'd actually be a higher number. So always go based on the annual percentage yield. What does this illustration, what does this rate chart actually show us the account value is going to be at the end of the 3-year, 5-year, 7-year, whatever time period, okay? The other thing that you want to make sure of is how the interest is actually credited. There is simple interest and also compound interest. We have a lot of agents or a lot of consumers coming up and say, hey, look, your rate of 5.5%, I'm actually getting 6.25%. I'm getting 6.5%. I go, hey, that's fantastic. Is it simple interest or compound? A lot of people don't know. A lot of agents don't know. You want to make sure that it's compounding interest. Or if it is simple interest, there's nothing wrong with that. Just make sure you understand that getting 6% return over 3 years simple interest is a lot different than getting 5.75% compounded over 3 years. You have to do the math. The most important thing to look at, especially while you're learning or if you're a consumer watching this, is what am I actually guaranteed at the end of the period? If I put $100,000 in and I'm guaranteed, say, $18,000 in interest at the end of it, what's my actual rate of return? Okay? And if it's a 3-year period, you know that's a 6% simple interest. But if it's an off number because of the compounding effect, you know it's compounding. Okay? You want to make sure that you as an agent or a consumer actually understand what your annual percentage yield is. The most common type of MYGA is compounding interest. Very simple, straightforward. You park $100,000 in, you get whatever rate of return at the end of it. And to get access to MYGAs, you always want to be able to show your consumer, or if you're an agent learning about this, you want to be able to get a rate sheet. Now, in today's world, it's way easier to get rate sheets than what it used to be. In the past, you'd have to call every single company. Now there's software. There's lots of software out there. There's Annuity Rate Watch, there's Annuities Genius. For the MYGAs, we generally will use Annuity Rate Watch. and you can get a full list of all the top most competitive carriers. What this software also allows you to do is to show your client, or if you're a consumer watching this, if you want to get a printout sheet, make sure your agent is showing you the entire industry. Don't be buying an annuity on a MYGA just because one company says that they're the best. They may not be. You want to see transparency. And if you're an agent, you want to show transparency and say, hey, look, here's all the top rates, all right? But what this sheet will also share with the consumer and yourself is the ability to see if there is access to the money. Some MYGAs will offer a higher rate of return, but then in return for that higher rate, they say you cannot touch the contract at all. There is zero free withdrawals, nothing. If you try to touch this, there's going to be big penalties. So if the client is looking to not touch it whatsoever and does not care about access, awesome. They can generally get a higher rate of return. The other thing that's really important is taking a look at the death benefit. Some of these MYGAs that pay a higher rate of return, there is a market value adjustment and a surrender charge associated with a death benefit, which is not as commonly seen as with the fixed index annuities. So you want to make sure, hey, if this is the #1 top company with this high rate, is this really going to be the best for my client? Maybe they would like to have interest-only access or 5 or 10% withdrawals. Maybe they want to have cumulative withdrawals. Maybe it's important to them if they pass away that their family gets all of the interest that has been earned thus far, and there are no charges to pass that contract down, because that would be a very awkward situation when you go to deliver a death claim check if that happens. So you want to be sure that you understand the contracts. And the good news is it's not complicated. It's going to clearly state, look, if you die, there's a surrender charge applied or a market value adjustment in addition to that. Or there's not. It's whatever the account value is at the time of passing. Those are the ones that we generally lean towards, even though the type of MYGAs that have zero access and they have death benefit charges, I try to stay away from those because yes, they do pay a little bit higher of a rate, but you're also taking away quite a bit from someone. But I will do the right thing and I'll explain to the client, look, you can have this one or this one. Which one would you most rather prefer? And generally speaking, most people are going to go with the one that has a little bit of flexibility, a little bit of access to the money. If they pass away, their family gets it all back. They're going to go with that type of policy itself, okay? Now, the other thing that you want to look at when it comes to the MYGA is the carrier rating. Some carriers, they may be only a B rating. Maybe it's not that big of a deal. Maybe they're not putting that much money into it. Other carriers will have a B plus or an A minus or an A plus. Generally speaking, the carriers with the higher ratings, they're going to have lower rate of return, lower MYGA yields versus the carriers that are B or B plus or B plus plus and so forth. A lot of people ask me, well, which one do you feel most comfortable with? Well, I like to go with carriers personally that are at least a B plus and higher, and preferably a B plus plus. And that's just because of knowing what I know in the industry. I want to have a good carrier with good reserves, and it's going to be stable and solidified with the client. I also want to make sure this carrier is not necessarily brand new. There's a lot of new carriers just popping up out of everywhere. I want to make sure that they have some history behind them. And then maybe the carrier name in itself is relatively new, but the people who purchased it or the group that purchased it, they've been around for quite some time. It was revamped or renamed through an acquisition. I feel equally as comfortable with that as long as there's some sort of a history there or some large financial backing. That's going to give you more confidence in helping your clients pick the right MYGA and also a part of your ever learning in the annuity space. So you want to research carrier ratings, the free withdrawals that can happen. You also want to take a look at the death benefit structure. Is it simple? Is it compounding interest? It may sound like a lot, but it really isn't. And you understanding these basics is going to help better position not only yourself in this business, but also be able to help your clients out better. I mean, ultimately, that's the whole goal. That's why we do this. We want to help people protect and preserve their retirement assets, all right? Now, the other cool thing about MYGAs that many of you may not know is if you write a check from a banking account, like just regular check account, just boring old cash, and you send that money to an insurance company, it will be given the interest, but the interest is actually tax deferred because it's inside of an annuity. Annuities have different tax treatment on non-qualified money. And when I mean non-qualified, I'm talking about money that is not inside of an IRA, a Roth, or a 401k. This is just cash in the bank, or maybe they have a brokerage account, or maybe they have some money underneath the mattress. All right, doesn't matter. It's just cash. The cash goes into the annuity. It grows tax deferred, unlike a CD or other types of high yield interest rate accounts where they will 1099 you each year. It will be tax deferred. And then at the end of the period, if the client chose to move that money out into another annuity, you can exchange it, called a 1035 exchange. And now you're taking the annuity that's already over its 3-year period and all the interest, and you're moving it to another annuity, and you're not paying any taxes on any of that interest. Now, reciprocally, if the client wants to access some of the money, it's interest first, okay? And there's no separation of it. You can't separate the basis on annuities when it comes to distributions or taking withdrawals on it. It's last in, first out. So if you take out money, and the client can't say, I'm only going to take from my basis, not the interest, I won't pay taxes. That's not going to happen. They're going to get a tax bill. Now, let's say they took out a free withdrawal and it was greater than their actual interest being credited. Well, they'll get ordinary income tax. There's no long-term capital gains or anything. It's just ordinary income tax on that interest portion. And then the principal portion that they started with, their basis, they won't have to pay any income tax on that. And then you'll have to help the client understand how to take a withdrawal from it. And it's not complicated. It's a 1 or 2 page form. They just simply elect what tax withholding percentage they want or a specific dollar amount, and then that gets withheld and reported to the IRS. Then the client gets their net benefit check from the carrier itself. So knowing these basics will help you accelerate your career dramatically, all right? Also, what you want to look at to help people understand this is you could show them CD rates. You can't advise on them unless you're working at a bank, but you can at least show people, hey, look, here's top CD rates, here's top money market accounts, and here's what MYGAs do. And if you take a look at that, MYGAs will generally yield more than that. Now, given there's some flexibility points there with those other types of assets, such as liquidity ratios and instant access or very small penalties if they cancel the CD early or the money market. But at the same time, if they're looking to park the money aside and let it sit there and accumulate and grow, it could be a really good policy for them, giving them nice interest that's safe, it's consistent. You don't have to worry about the ups and the downs of the market. You don't have to worry about how much interest might be credited if the indexes actually perform. None of that. It's just straightforward. Here's the money, here's the contract, here's the interest that gets accumulated into it. I hope this video was helpful. You need to do your research, and if you're a consumer watching this, you should also do your research and read about different companies offering MYGAs and the intricacies of MYGAs to see if they're actually viable for you. They are not for everyone. There are a lot of people out there that say, hey, look, I don't want to just park it for 3 years, because if we had to find a downside to MYGAs, what are rates going to be at the end of starting in the 4th year? We don't know. That's the problem. We don't know what the rates are going to be. So yeah, locking in at 5% for 3 years could be the best decision ever. But then if rates are significantly lower in the future, and let's say the new MYGA at that time is only 2%, wow, you should have got a 7-year plan or a 10-year plan. Okay, reciprocally though, if rates go up, then you're still stuck in this 5%, that's not very fair either. So it's all about a balance. And this is why a lot of people that we work with, they will end up, if there's a certain goal in mind to reposition to a MYGA, let's say it's 100,000 or 200,000, let's say it's 200,000. They'll put 100,000 in a 3-year and 100,000 in a 5-year. They'll kind of split that difference. So that way in 3 years, that 100,000 plus all the interest is 100% liquid. And then on the 7-year plan, they still have a few years into that one, but they're still balancing and getting that extra interest. Even though the rates may be better on new plans, they have that other 3-year that's been freed up. Okay, but reciprocally, if rates are lower, hey, look, now we're going to try to find out what to do with this 3-year. But at the same time, that 7-year is still yielding that good rate. So think about MYGA blending, or as more commonly known, MYGA laddering. You may have heard of CD laddering. You can do the very same thing with MYGAs, multi-year guarantee annuities. This is why it's important to shop the market, understand the products, and it will help you excel in this career, because most financial advisors and insurance agents, they don't have access to the whole market. So wherever you're getting your contracting from, make sure that you have access to multiple different carriers so that way you can stay competitive and ahead of the game.